All right, good afternoon, everybody. I hope you enjoying your weekend. Let me get you right on through this watch list, and you can finish enjoying your weekend. So, just four stocks here that I'm looking at. Um, all but one are undefined. I'm sorry. I know sometimes not everybody can do undefined, but lately it's been hard to try to find defined risk plays. So, but there is one on here. All right. Now, that being said, everything is definable. It's more or less along the lines of how little credit do you want to make it defined. Okay. So, all right, let's get started here. First one that I'm looking at is GDX, right? That is the ETF gold miners. Want to lean this one short here a little bit. Let me go over here and show you really quick. GDX, clearly definite downtrend below the 200-day, stacked to the downside here. All right. So I want to go ahead and play this to the downside, but not just with a short call. You know, I don't need that many short deltas. So I just want to take it down, but do it with a short skewed strangle. And as you can see, like I said, we are stacked to the downside. So I'm looking at having one of my strikes, the call side, up here right at the 200-day, and then my put will be well down below support here, giving a lot of wiggle room should it continue to fall. All right, so we're gonna go into November monthly, and I want to go ahead and sell that 25 put and that 35 call. Try to get, you know, ideally I'd like to get 34 cents, but we'll see. You know, it'll vary between a couple of pennies. And right now I'm looking at 3 contracts at least, with 34 cents will give me about $1.02 and only cost $900 to put on, all while giving that 85 pop, a 91 P50, and leans me almost 5 delta short. So not too crazy. Okay, that's the first one. The next one that I'm looking at, let me get it ready, is gonna be Coke. That's KO, right? And I'm looking at this one for a covered call. All right, Coke's been on a good uptrend, and I actually did it here before COVID too, and then recovered a little bit, and now we're pulling back to that 200-day. So what I'm looking for is it to bounce off the 200-day and start to return back to those highs. Okay, so what I want to do, let me just put this on the mark here as well. That's not where I want it. All right, it's 56 calls. Okay, that's inside the expected move. But what I'm looking at is a covered call. So this is going to be 100 shares of Coke, and then I'm going to go just 30 days out. Okay, I don't like to be in covered calls too long. So I want to do the 100 shares, and then I want to sell on the October 22nd weekly, 33 days out, which tomorrow will be 32. I want to sell the 56 call. Okay, right around 53 and a half, 53.60. You know, it's going to cost $2,700 to put on. Ultimately, this is a bullish play. Even though you're selling a call, you also have that 100 shares. And what I'm looking at is for Coke to rally back up and have the 56 strike be in the money by expiration. This gives a max profit of $240. Now, if Coke isn't reaching 56 by expiration, then I will go ahead and roll it out, and probably at that point take the November, or even there'll probably be a weekly open by then, so somewhere in the November range. I'll just roll it on out, keep it going, but stay right around this 20 delta. Usually I like to go right at the top of the expected move and look for it eventually to expire in the money. Okay, all right, and next here is gonna be MRK, right? American Co. And this one, just going to do a straight neutral strangle. If I zoom out, you can see it's a little choppy. It is technically bearish below the 200-day stacked. But what I'm looking at is a range that it has been in for quite a while it's downtrending. It actually looks like we have more room to the downside, but it leans delta neutral. Okay, so plenty of resistance runs, plenty of support, and I want to just take this with a straight strangle. So MRK November, and I want to sell the 62.5 put and sell the 85 call. As you can see, that is well past expected move. It gives almost a 90% pop. try to get at least say 55 cents for it with a minimum of 2 contracts. 110 bucks, slightly high in the buying power. Okay, 1,400, almost $1,500. But I'll take this high buying power for such a high probability of success. All right. You know, like I was saying here, define risk. You know, if you wanted to iron condor it at the 20 delta, you can see that it's only 89.90 cents. Now with 2 contracts, it makes it possibly doable and would be cheaper to put on than as a strangle. However, iron condors are a little bit harder to defend. But that is an option, okay? Like I was saying, it is always doable to define. It's just a matter of how little credit you actually want to do. All right. And now the next one that I'm looking at here, gang, is going to be Microsoft. I like Microsoft. Want to take it long. You can see it's had a nice run up. Made those highs. We consolidated. And it's still above the 8 EMA. Okay. We got a little bit of a squeeze. Still pretty bullish. So I want to take this one long. This one will be defined risk. So I'm looking in the November 5th weekly cycle, only 40 days out. Right around that 33 delta. So ideally, I don't like to take anything less than $1.30. So I'm going to be watching the 290, 285 put spread. Okay, I would like to get a $1.30 here. That'll give you your 63 pop. Define you 130 bucks, $330 max loss. But again, I don't like to take anything less than $1.30 if I can avoid it. Okay, so that's it, gang. One defined. And technically, actually, Coke would be defined too because your shares will get caught away. So yeah. All right. Well, that's it, you guys. You have a great rest of your weekend, and hope to see you one day in chat. Take care.